Pakistan's dependence on foreign financial support is deepening, with Saudi Arabia adding another $3 billion to Pakistan's reserves. The fresh support comes as Islamabad continues to rely on external assistance to shore up its finances and bolster its foreign exchange reserves. And that takes Saudi Arabia's cash deposits with Pakistan's central bank to $8 billion. For Islamabad, this provides critical support for foreign exchange liquidity and external financing. But there is an important distinction here because this is not a structural solution to Pakistan's external financing problem. It is another round of support that helps the country manage its immediate financing pressures. And now Pakistan is looking towards Washington. Finance Minister Mohammad Aurangzeb has confirmed that Islamabad has formally sought a $10 billion exchange stabilization support facility from the United States. The government says that this is not supposed to be a conventional loan or credit line. Instead, Islamabad wants it to act as a signal of confidence in Pakistan's currency and foreign exchange stability. Well, the idea is simple. A stronger external backstop would improve investor confidence and help Pakistan return to international capital markets for longer-term borrowing. The government says it wants to move away from repeated bilateral rollovers and towards 5, 7 and even 10-year market financing. But there is one major question. Will Washington agree to this? Well, the risk for Pakistan is that if the US facility does not materialize, the country will still have to meet its external financing obligations, and that would leave Islamabad with fewer options. It could have to seek more support from existing bilateral partners. It could have to negotiate further debt rollovers, or it could have to return more aggressively to international capital markets. The government says it wants to move towards a B+ rating and longer maturity debt. But that transition requires something more than foreign currency inflows. It requires stronger fiscal management, higher exports, greater investment and a reduction in the country's dependence on repeated external support. And that brings the story back to the central problem. Saudi money can buy Pakistan time, Chinese rollovers can buy Pakistan time, and a potential US facility could buy even more time. But none of these by themselves change the underlying economic model. Pakistan's challenge is no longer just finding the next $1 billion. It is building an economy that does not need to keep asking for the next $1 billion. And until that happens, every fresh deposit, rollover or bailout risks becoming another lifeline rather than a way out of the crisis.